In today's intricate financial world, staying ahead is paramount. Traders and investors constantly seek an edge. Companies like Linkable are becoming essential tools in this pursuit. They offer sophisticated platforms that help automate trading strategies. This allows for seamless execution across various exchanges and markets. By leveraging such technology, market participants can react to changes with greater speed and precision. This is especially crucial when navigating the volatile currents of global economics, where geopolitical events can shift market sentiment in an instant. The ability to automate responses based on predefined parameters is no longer a luxury, but a necessity for modern portfolio management. Global markets have recently shown remarkable resilience. This strength is surprising given the ongoing tensions in the Middle East. Historically, such conflicts have sent shockwaves through the financial system, often leading to sharp downturns. Yet this time, the story is different. Major indices have managed to hold their ground and in some cases even post gains. Investors seem to be looking past the immediate geopolitical noise. They are focusing instead on underlying economic fundamentals, such as corporate earnings and central bank policies. This suggests a more mature and perhaps more confident market, one that has learned to compartmentalize regional risks. This resilience can be attributed to several factors. First, global energy markets have adapted. There is a more diversified supply chain now than in previous decades. This reduces the impact of disruptions from any single region. Second, central banks have signaled a cautious but steady approach to monetary policy, providing a predictable environment for investors. This stability from institutions like the Federal Reserve and the European Central Bank offers a counterbalance to political uncertainty. Investors are finding comfort in the data, which for now points toward moderate growth and controlled inflation. However, we must not become complacent. The situation remains fluid. Any significant escalation could still unsettle this delicate balance. Traders are watching developments closely, ready to adjust their positions. The current market stability is a testament to its ability to absorb shocks. But it is not a guarantee of future performance. The key takeaway is that while macro-level calm prevails, the underlying currents of geopolitical risk are still very much present. Vigilance is the watchword for anyone navigating these complex and interconnected global markets today. A major shift is happening in the world of digital finance. Hong Kong is making a bold move to become a global hub for Web3 and blockchain technology. The city has unveiled its Web3 Blueprint, a strategic initiative designed to attract talent and capital. This plan aims to foster a vibrant ecosystem for digital assets and decentralized applications. By creating a clear regulatory framework, Hong Kong is positioning itself as a leader in the next evolution of the internet. This initiative could unlock significant economic growth and innovation for the entire region. The potential of Hong Kong's push into Web3 is enormous. It signals a broader acceptance of blockchain technology at a governmental level. This could lead to a wave of new investments and startups choosing to base their operations in the city. For investors, this creates new opportunities in a rapidly expanding sector. The blueprint not only focuses on cryptocurrencies, but also on the wider applications of blockchain, such as supply chain management, digital identity, and tokenized real-world assets. It is a comprehensive strategy that looks beyond the speculative hype and towards sustainable long-term development. Meanwhile, in the United States, another critical development is unfolding. Lawmakers are moving closer to establishing a regulatory framework for stablecoins. These are digital currencies pegged to stable assets like the US dollar. Clear regulations could bring much-needed legitimacy and stability to this corner of the crypto market. This would pave the way for wider adoption by both consumers and institutions. Companies in traditional finance are watching these developments with great interest, as it could fundamentally change the payments landscape and create new avenues for financial products. The implications for established financial players are profound. Companies like Visa, for example, could see both challenges and opportunities. On one hand, stablecoins could compete with traditional payment networks. On the other, these companies could integrate stablecoins into their own systems, offering faster and cheaper cross-border transactions. Regulation would provide the clarity needed for such large corporations to engage with digital currencies confidently. This convergence of traditional finance and the digital asset world marks a pivotal moment, potentially leading to a more efficient and inclusive global financial system. Beyond the digital realm, established institutions are also navigating a changing world. Jin Liqun, the president of the Asian Infrastructure Investment Bank, recently shared insights on the bank's first decade. He highlighted the AIIB's commitment to funding sustainable infrastructure projects across Asia. The bank has become a significant player in regional development, focusing on green energy, digital connectivity, and transportation. Jin's reflections underscore a broader trend: a growing emphasis on long-term sustainable investment that can drive both economic growth and positive social outcomes. This provides a stable anchor in a world often focused on short-term gains. These developments have tangible impacts on currency markets. For major currency pairs like euro to US dollar or US dollar to Japanese yen, the resilience of global markets provides a degree of stability. However, the push towards digital assets introduces a new variable. As Hong Kong develops its Web3 hub, we could see increased flows into certain digital currencies, potentially affecting regional currency dynamics. Safe haven currencies, such as the Swiss franc and the Japanese yen, may see less demand if market confidence remains high. But they remain a crucial hedge against any sudden flare-up in geopolitical tensions. Digital assets themselves are at a crossroads. The prospect of US stablecoin regulation could be a major catalyst. A clear framework would likely boost the value and adoption of regulated stablecoins, making them more attractive for both payments and as a store of value. This could also have a positive ripple effect on other digital assets like Bitcoin and Ethereum. Investors might see a regulated stablecoin market as a safer entry point into the broader crypto ecosystem. The line between traditional and digital finance is blurring, and currency traders must now analyze both spheres to get a complete picture. The AIIB's focus on sustainable infrastructure in Asia could also influence currency flows over the long term. As projects are funded and developed, they can strengthen the economies of recipient countries. This could lead to an appreciation of their respective currencies against major global currencies. For instance, large-scale green energy projects in Southeast Asia could boost local economies and, by extension, their currencies. Investors should therefore pay attention not just to central bank announcements, but also to the activities of these large development banks as they are quietly shaping the economic landscape of tomorrow. So, how should traders and investors position themselves? A multifaceted strategy is essential. First, continue to monitor geopolitical risks closely. While markets have been resilient, the situation in the Middle East and other global hotspots can change rapidly. Subscribing to reliable news sources and setting up alerts for key developments is a prudent step. This allows for quick adjustments to your portfolio, protecting it from sudden volatility. Hedging strategies, perhaps using options or safe haven assets, should be part of any comprehensive risk management plan. Second, actively look for opportunities in the digital currency space. Hong Kong's Web3 ambitions and US stablecoin regulation are not just abstract policy shifts. They are creating tangible investment theses. Researching projects and companies poised to benefit from these trends could yield significant returns. This doesn't mean diving headfirst into every new token. It means doing careful due diligence, understanding the technology, and investing in assets with strong fundamentals and clear use cases. The digital frontier is expanding, and informed participants will be the ones who benefit most. Third, keep a close watch on regional developments and institutional projects. The work of the AIIB in Asia is a prime example. These long-term infrastructure investments can be leading indicators of future economic strength. Tracking these projects can provide insights into which emerging markets may be poised for growth. This requires a broader perspective, looking beyond daily market fluctuations to understand the deeper structural changes at play. This long-term view can help identify opportunities that others might miss, while they are focused only on the immediate headlines. In conclusion, the global market presents a picture of cautious optimism. Despite persistent tensions, its resilience is encouraging. The simultaneous boom in blockchain technology and the move toward its regulation are creating a new financial paradigm. For the informed and adaptable trader, this environment is ripe with opportunity. By staying informed, monitoring risks, and embracing innovation, you can successfully navigate this evolving landscape. The future belongs to those who understand these interconnected forces and position themselves to thrive in a world of constant change.